Hello, everyone. Welcome to Real Estate Right Now, where we talk about real estate matters that matter to you. My name is Jay Izzo, and we are live here from Lindencraft Team Studios, Raleigh, North Carolina, part of the Greater Research Triangle Park. Today's show is one that we have wanted to do for a long time. We just had a very difficult time setting up a schedule to make this happen. We're going to talk about real estate as part of your financial portfolio and as part of your financial future and in terms of an investment. So what we decided to do is we decided to find who could we get to talk about that. So we got Adam Whitesell, who is managing director of Inspired Capital and Forbes
Best in State.
Forbes Best in State by Ameriprise.
That's right.
And he's going to join us here this morning because, got to tell you, if there's a question that we get a lot, it is real estate and investing. How do I make that work as part of the portfolio? Should I even do that? And so we're going to try to do that today. So Adam, welcome to the show.
Thanks, Jay. Appreciate being here.
All right, so let's get started right away. How does real estate fit into a well-diversified investment portfolio, or does it?
Absolutely, it does. I mean, there's lots of different forms of how you can buy real estate, first of all, but maybe a good place to start with this question, Jay, is to sort of peel back a little bit as to what diversification really means.
Yep.
Diversification, I think, simply is having different groups of asset classes.
Mm-hmm.
And asset classes are just groups of investments that behave in a similar manner. And diversification is having different asset classes in your portfolio in order to increase the return, reduce the risk, make sure that you're, making good financial decisions. And, at the end of the day, real estate by its very nature doesn't really behave like stocks or bonds, right? Mm-hmm. It's got its own characteristics. Some produce income, some have appreciation. So it kind of does a little bit of both. Mm-hmm. It has some inflation protection aspects to it. Rents can go up over time. And certainly price appreciation over time. And then the other big thing when it comes to diversification is what we in the industry just call correlation, right? Correlation is simply, an investment moving in a similar direction. You've got two stocks, Lowe's and Home Depot, for example. They're going to do similar things in certain market environments. But having an asset class like real estate within your portfolio, if the market's not doing well, the bond market's not doing well, it can fluctuate a little differently, which helps you with that risk return profile.
Here's the thing that's interesting about the real estate piece is, first of all, it's not necessarily an easy piece to invest in because it requires more capital typically than a lot of the other investment classes, right?
Good.
I mean, there's no Robin Hood for real estate.
No.
do you know what I mean? Right. There isn't, and I'm not suggesting that you should do that, by the way, in any reason, but there is nothing like that because it is a pretty expensive class. Whereas, if I got a mutual fund, right, I remember back in my younger days of, putting some money aside and investing it, right? They put me in mutual funds, right? I didn't have a lot of money while I was getting my first job, but it was a couple $100, but I could diversify it over things and I could get in there. For a couple $100, I can't get into real estate.
That's correct. Right.
So there is some challenges there. And then, there's also some challenges with regard to residential versus commercial real estate. And cap rates, which we start getting into weird numbers and things like that, right? So it's not easy, but it can be effective. And I guess now, and this isn't part of our questions, I'm sorry to do this to you. Do we find any sort of correlation between people who have real estate as part of their portfolio or don't, in terms of that they are able to do more or less, or that the portfolios are more stable or not stable? Do we find anything that's correlated at all?
Favorite answer from a financial advisor: it depends.
I kind of knew that answer was coming, believe it or not. I kind of knew. Yeah. Because it's hard, right?
It can be, but it doesn't have to be. I think real estate comes in so many different forms, right? So if you think about just like local rental market, right? Real estate's so localized, right? You got to have a great agent. You got to know what you're doing from that standpoint. You got to know your cap rate. And you got to know what, you're kind of getting into if you're using leverage or property managers or, mortgage or anything of that nature. But, it doesn't have to be complicated. You just need to know exactly what you're getting into and make sure that you're, setting up your portfolio to not go too far in one direction or the other. Just like you wouldn't have a portfolio that's like necessarily like 100% stocks. If you're approaching retirement, need to rely on income. If you're looking for,
balance is still a key.
100%. 100%. Balance is always the key, right? There's so many different ways to derive income and derive growth in this world. And, just like you wouldn't put 100% of your portfolio in the S&P 500, you're ignoring 70% of everything else out there if you do that. And so having some nice balance, it gives you some non-correlation. It gives you alternative streams of income from, being passive income. But it's certainly not for the faint of heart.
People ask questions about REITs, REITs, right? Real estate investment trusts.
Right.
Is that a realistic thing for people to consider, or who maybe should consider that as part of a portfolio?
Depends.
Yeah, of course. Yeah.
But yes, so there effectively, there's two ways to, invest in real estate. You invest in the hard asset, you take the rental real estate example, you buy the house, you rent the house, you take the cash flows. At some point in the future, you get the appreciation. REITs work the same way. Now, you could argue that a REIT, a real estate investment trust, whether you're buying an ETF or mutual fund, is more diversified. It's across, a national landscape, potentially. It's across a particular class of real estate, like multifamily or, storage facilities, whatever it might be, Class A office space. However, the interesting thing about, like the rental real estate example versus the REIT example is the REIT, when you look at your statement or you look at, the financial markets, that price is moving every second. And if you're owning, a real estate house, like you're not going to Zillow every single second of the day to see what your portfolio was worth.
Right.
What's the Warren Buffett quote? Like the best make a good investment and then don't look at it for 5 years and you'll be pleasantly surprised. Right. And I think a lot of real estate investors, that's kind of the mentality that they take. Is you buy the rental property, you've got the income coming in, you feel confident you're going to get some appreciation. And if you manage that property correctly and had a good buy, like you're going to wake up and have more money.
Yeah. In a REIT, you're not in control of that because you're counting on somebody else to make good good financial decisions on that. And so and like you said, it can be part of a mutual fund. I know that there's some REITs out there that are part of mutual funds, but I know you can invest in them on their own as well. And so, maybe it's a lower, it's a lower entry.
Yes. Yeah. You put $100 in one. And,
It's exactly. A lower entry into the real estate
100%,
market.
Right.
That's available to people if they really love real estate.
Correct.
That may be a lower entry way into it. I think what we don't know is we see it, but I don't think we understand it very well.
Right.
The average person in the public, I don't think understands it very well.
Right.
But really, it's somebody who owns a conglomerate of properties, and they're looking for money.
Right. You don't own the whole property. You just own a small piece of it. Maybe a brick. That's okay.
Maybe.
It's all proportional.
It may be the mortar.
Right.
You own a piece of the mortar. Right. And again, it's like everybody contributes to it, and that makes up all the whole portfolio of it. But it may be a nice entryway for people if they're really interested in doing it. And, like any investment class, and we have to say this, nothing is guaranteed.
Right. No, nothing. There's
no guarantees. So we have to do that. How can real estate investments help with tax optimization strategies?
This is a great question. There's basically 3 key components to taxation of real estate. The first one is like, if you own the hard asset, rental property, for example, you do get the benefit of depreciation potentially. If you choose to declare that on your tax return. Depreciation is just offsetting essentially some income while you own it, right? So you essentially kind of pay less tax on the income that's coming in. The other aspect with that is also you can deduct expenses against it. So if you've got a rental property and you had to put in a new hot water heater, or you had some lost rent for that month, you can actually offset that against expenses. So for current income, there's a little bit of benefit that's there. Now, you'd have to recapture that if you sell the property. So that's the thing I feel a lot of times that people get confused on. They're like, wait a minute, like I just sold this property. I know about capital gains, but like what's depreciation recapture? That's a little bit of a sticking point. But the other two main things about real estate investments that could be beneficial, number one, it's tax deferred appreciation, right?
Right. Yeah.
You know, it's an unrealized gain until you sell it, right? You buy a property for $100,000, you know, over the course of time, it goes up to $200,000. Like, you didn't pay tax on that $200,000 gain until you sold it.
So you sell it.
And then, you know, if you know, there's some certain tax laws out there. One, for instance, is called a 1031 exchange.
Right.
You can move it from one property to the other without having to pay that tax. And there's a lot of rules and regulations around that. So certainly consult CPA on that. But then the third thing that's still around today is what's called step up in basis.
Okay.
So if you own the property outright, you know, you bought it 20 years ago and it's appreciated nicely, and unfortunately you pass away, you know, you've got some heirs, you know, spouse, kids, family, whatever it might be. The way the current tax laws work is they don't pay capital gains on that appreciation. Now, there's a lot of other asset classes that actually work that way as well. But just some really neat things in the tax code, that, in particular for real estate, that can be pretty beneficial.
Yeah, I think it's interesting because, you know, as you and I have talked in meetings, you know, together, and about how investments work and our retirement, right, works, and, you know, the IRAs, whether it's a Roth or whatever we have, right, you know, you're constantly reminding us of, you know, at certain ages, there's some advantages, and then we're going to have to, at some point, you know, take something out.
If the IRS gives you a tax break, at some point you have to pay that back.
Right. At some point you have to pay it back.
Right.
And I think it's the, I think you have to think of it almost the same way. Correct me if I'm wrong, but you almost have to think about, if you invest in real estate over the long term, you almost have to think about that in the same way, right? Yeah, because you're making these gains,
right,
as long as you own it. But at some point, you do have to pay for it. Pay, right? You got to pay for it. It's not completely tax deferred.
No free lunches. There's no panacea for tax.
It's not tax deferred. It's tax deferred right now, but you're going to pay something eventually. And like you said, maybe the advantage is you die. I know that sounds crazy, but
but not an effective strategy.
But I mean, because then your heirs actually do get benefit. Right.
Absolutely.
So that's kind of a morbid way of looking at it, but it is the way it is. What factors should investors consider when deciding between residential and commercial real estate investments?
Great question. I mean, you know, at the end of the day, real estate is so localized. Like, make sure you've got a good agent, make sure you understand what you're getting into. You know, residential, you can design and acquire a portfolio arguably a little bit quicker, lower price points to entry when it comes to real estate. So you can, you know, kind of diversify in and out of your local area, or, you know, other areas across the country. Commercial real estate's a whole nother animal.
Yeah, it's a whole nother animal.
And so, you know, higher price points to entry, you're dealing with lease contracts, you're dealing with potentially multiple tenants. You know, it's just a whole nother world.
It is another, and reason we bring Baxter Walker in from Avis and Young in here, you know, 3 times a year, is because he reminds us that it is a way different animal than residential real estate. And it's not that it's not an effective investment tool, but it is extraordinarily different.
Right.
And you are talking about typically a much larger investment than you would in some sort of residential real estate. So there's certainly, you're absolutely right. How do you assess the potential risks and returns of real estate investment property?
First and foremost, starts with cap rate. You know, you mentioned it earlier, right? I think it's really interesting, because I've run into people all the time that, you know, kind of look at, you know, what their property portfolio looks like and providing them advice on it. And then I calculate the cap rate and show them that they're making 1%. And they're like, oh no, that can't be.
No,
like,
it can.
Actually, it can be.
Actually, it can be. No, it actually can be. It can be even less sometimes.
Exactly. Especially in a higher interest rate environment where you can get way more than that just sitting on cash.
Right.
So, I mean, that's the first thing to really understand too, because the appreciation variable and the assumption of what appreciation you're going to get can also vary wildly, right? And we don't know. We can't know the future. Right.
We don't know.
We've got to put some type of assumption that's in there. But the best way to look at it from a risk return standpoint is, okay, what's your current income, right? Because if that's going to how you play it, you know, for instance, it's part of your retirement income strategy. You know, you've got Social Security, pension, you know, IRA distributions, annuities, stock dividends. And at the end of the day, real estate can also be a piece of that. So it's just calculating like, what is this making me? And then the second question is like, what's my alternative?
Right.
In the example, you're making 1% on a real estate income or property. What's the alternative? Like, how much time are you putting into that as well? I think it's one thing a lot of people don't really think about. It's like ROT, return on time.
Yeah. Right.
They're managing themselves.
Right.
Property management companies charge, 10, 15, 20%.
Whatever the percentage.
Yeah, whatever the percentage is. So it's just kind of just knowing and understanding, what you've got to make sure that you're making the smart decision for the path forward. It's just like we talked about with like, public REITs, like a real estate investment trust, mutual fund, ETF, what have you. You don't have to do anything there, so you can make more on the individual property side, and then knowing what you get on the income from the real estate investment trust, and then make a decision like, is my time worth, is there more juice in the squeeze, right?
Right.
That's really what the conversation becomes.
And it leads right into my next question I have, which is, what role can real estate play in retirement planning and generating passive income?
Yeah. The way I think a lot of financial advisors, they focus so much on like stocks and bonds and, other types of investments.
Right.
Our firm's a little bit different because any capital asset you have, right, has appreciation potential, also risk of loss. Don't get me wrong. But it also has income potential. We go through life. It's kind of like the grocery cart of life, right? We're going down each aisle of the grocery store. We're putting in, the cereal, the bread, the milk, everything. We get to the checkout line, right? It's just like with retirement planning, like you're accumulating as you're going through life. And at some point, when the income's not coming in anymore from your job, profession, career, whatever it might be, you've got to recreate that. And there's tons of ways to do that. Real estate's just one component. I mentioned a few earlier with Social Security or pension or IRA distributions or annuities, or investments that pay an income like a bond coupon or interest off of a CD or a dividend from a stock. Real estate's another component of that. And to have a properly diversified portfolio, it's a good idea to have a good mixture of those things, because throughout times of the economic cycle, they're going to be in and out of favor.
Well, you're trying to limit risk on some level. Right. I mean,
variability of your portfolio is a killer when you're taking income.
Well, I mean, there's no way we can eliminate risk.
Right.
I think we have to make that really clear.
Right.
You cannot eliminate risk.
No, there's risk in everything.
If you invest in something, there's risk involved.
Right.
And it may not work.
Money buried in the backyard can get eaten by worms.
I'm just saying.
Right.
I'm just saying.
There's risk. Yeah.
Right.
Yeah.
Right. We're both married.
Right.
We took a risk. There's no guarantee it works out. Fortunately for us, it has done quite well for us.
That's right.
But there's no guarantee.
Right.
So it doesn't, we talk about money, but, the fact of the matter is everything that we're doing is a risk. There's no guarantees of how it's going to work out. You do the best that you can with it. Right. And you try to limit some of the risk as best as you can, but it's never going to go away.
Right. It's the proverbial all eggs in one basket.
Right.
If you've got it all in one direction, like that has to work out. That's why we diversify. That's why you have different income sources.
So what are your thoughts on the current real estate market conditions and the future outlook? And listen, I'm asking you this question from your perspective, because I have mortgage lenders on here and real estate people on here. And I ask them that question, and everybody gives me, depending on who they are, they give me, they give me different answers. Most of them are positive, but you are, a financial guy, you're a financial planner, advisor, managing director, Inspired Capital, right? Your perspective, how do you see the real estate market in the future?
Yeah, there's good spots and there's bad spots. I think coming out of COVID, people realized with just kind of the simple work from home, type situation. So like large, class A office space, skyscrapers, towers, and, large conglomerate type cities, like they're still struggling a little bit, to kind of fill space. So there's a lot of people that are coming back in, but then, you've also got the Amazon effect, so distribution warehouses, shipping facilities, with the new tax laws with qualified opportunity zones, which if you don't know, it's taking more depressed areas, and the government has kind of sketched out exactly which areas for this qualify, but to really bring in a lot of development, and they're providing a lot of tax benefits, for get to people to do that, to continue to develop underdeveloped areas and add to employment and those types of things. And so there's definitely some bright spots within that, inside that, within sort of the infrastructure space, across the United States. But, with that aspect of real estate too, and we're also struggling with, certain areas of the world or certain areas of the U.S. have population outflow.
Yeah.
We don't have that we don't have that problem.
That's
in
not
Raleigh.
our problem in North Carolina right now.
I mean, we're birthing a kindergarten class a week, and then we're getting 50 families or something moving in.
Ridiculous.
Yeah, it's pretty wild. So
Stacey Edmondson, who does all these statistics, I asked him for a specific number. Right. And here's what he told me. He goes, here's what I'll tell you. There are significantly more people coming in that are leaving.
That's right. 95% of statistics are made up on the spot. I just made that up.
Well, yeah, that's what Abraham Lincoln said.
Right. That's right.
On Facebook.
Right. Right. Yeah. So there's a very positive outlook. I think, there's only so much space. There's only so much development. I think with the interest rate environment that we're in and have been in the last couple of years, with that potentially subsiding, we're going to know more at our Fed meeting here in a few weeks. But
it's coming down. I'm just telling you right now, it's going to come down because it always does in an election year. I'm just telling you. We have said this. We have said this on the show for 2 years.
Yeah.
That you wait prior to the election.
Yeah.
Interest rates will go down. It is a historical. I know it's a correlation. I know it's not a cause and effect relationship, but if you look at the last, how many ever elections, the interest rate seems to go down.
It seems like it will at some point, right?
And Yellen is already saying something to that effect.
Right.
All right. Last question. What are some common mistakes you see real estate investors make, and how can they be avoided?
Ooh, how much time do we have?
Not as long as you'd like to think we have.
That's right. There's actually quite a few things here. I think one thing that we talked about earlier is like people not knowing what their cap rate is.
Right.
That's sort of a big thing just for expectations of what it might be. The other thing, I think the biggest thing is real estate can be so emotional.
Yeah, it is.
It's sometimes I find a lot of times like families, like, keeping the family house and the kids don't want it,
But don't you think all investments are emotional on some level?
Oh, yeah, absolutely they are. Right. Everything.
I mean, don't we say this about the stock market? The stock market is an emotional market.
It absolutely is. And this is a whole nother podcast because there's a huge aspect of the emotional aspects of money, and how that operates. But and that's the biggest thing when it comes to the real estate valuations. Again, people aren't valuing their properties every single minute of the day, and it's not, put on the media and the news, and it's all the different publications that are out there. But yeah, the mistakes are not knowing what you're actually making,
right?
Having grandiose ideas of what it can be because you read or heard or somebody else did something. From an estate planning perspective, it's having something kind of locked up for beneficiaries. Like I've got a situation that we worked with that this family owns this hunting lodge, and they've owned it for, I think it's like 4th generation now. The great grandfather, put it into a trust essentially for the family to keep it in there. And now this property has like 67 owners, and they all have to agree before they can do anything with it. The trustee doesn't even know who all the owners are. My
mom did something similar to this, right? Yeah. When she did her will, my mom passed about 4 months ago, and she decided to include, instead of just my sister and I right, she's included grandchildren and great-grandchildren. Right. So now,
well-intentioned,
her little house in Ithaca, Nebraska has to be divided 14 ways. Right.
And it's well-intentioned, but not necessarily thought out. Right. Having a good estate attorney, having a good CP, having a good real estate agent, like somebody's going to say, look, let's actually think further down the road. Like what could happen? I think that's the biggest thing when it comes to real estate that people get a little bit misguided on. It's not a cure-all, right? It has a lot of benefits. Know your risk, know your income, and just think logically long-term about, are they really going to want this? Yeah. Right. Yeah. It's we've done our time.
I told you. I told you.
You told me.
I told you this.
You're
is
right.
Gonna,
Jay's always right.
I told you this is go quick. Tell people how they could get a hold of you if they want to talk to you more about their financial plan, investing, and so that they can get more information. How can they reach you?
Absolutely. Easy thing is go to our website, inspiredcapitaladvisors.com. You can also catch me at adamwhitesell.com. That's Adam, WHITESELL.com. Or just give me a call, 919-227-3171.
We have a rule in radio, because in podcasts, is you can't say your phone number just once because people will never remember it. So you have to say it.
919-227-3171.
See, now people, because now people are going to write it down. Thanks for joining me, Adam. Folks, this is a show. You know what I say to you every week, and that is this. You got a lot of choices. You chose us. Thank you for doing that. We really do appreciate it. I am grateful from the bottom of my heart that you watch us. Give us a thumbs up on YouTube, watching us there, and wherever you're listening, right? Give us a 5-star positive review somewhere, whether that's Spotify or Apple, iTunes, wherever it may be. We're on all of them, right? And because we'd love to hear from you. Reach out to us. We'd love to hear from you anyway. As I say to all over the world, you know what that is. Ciao